To invest 10 lakh rupees, it is important that you reduce the risk, and you must follow these rules to reduce your risk substantially when you are investing such a large sum of money.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, do you have a considerable amount that you want to invest but are not sure how to go about it? Invest it in installments or probably in one go? More importantly, are you wondering where to invest? Stocks, mutual funds, government securities, or elsewhere? Well, watch today's episode because today we'll try and help you out of this dilemma of yours. Stay tuned.
Ideally, no one should invest lump sum because as you are accumulating, if it is being accumulated from your regular income, the ideal thing is that you invest as you earn. But for some reason, either you have accumulated or somehow you have got 10 lakh rupees to invest, then there are ways of looking at it. I don't think there is a straight answer to this question. It entirely depends on your investment time frame. If this 10 lakh rupee is the money which you need within 3 years, then your option is very simple. Invest in a debt fund. Invest in a debt fund and invest in a relatively stable debt fund. And that stable debt fund is either short-term debt fund or ultra short-term debt fund. They are not subject to the big wild movement we see in debt funds when interest rates change. And another thing is that when it comes to debt fund, you can invest lump sum. You can invest at one go simply because you don't have that big risk of catching a market high when investing in a debt fund, and you are investing conservatively. If you are investing for any time period of 3 years and more, but you are likely to need it before 5 years, it's not an investment which you don't need the money in the foreseeable future. Then you should be conservative. You should be 70-80% into debt, remaining into equity. And for this, you have conservative hybrid funds available, which can make your investment simpler. And here too, you can invest your money or your debt fund allocation at one go, or maybe if you are investing in a hybrid vehicle, a fund which is 60-70% into fixed income, remaining into equity. Spread it over the next 2, 3, 4 months, so that you average it, because anything with equity, you run the risk of catching a market high, and that is very disappointing for any conservative investor. When it comes to investing for 5 years and more, then your choice is very straightforward. It should be equity. When investing in equity, you are never investing at one go. This money should be spread over a period of time. Over what period of time? I would say that the first rule is how much time it has taken for you to accumulate. It is my rule. It is something which I keep in mind because that actually signifies how important that money is. So the first rule is that if it has taken you 3 years to earn this money, then spread it over the next 1.5 years. But assuming that if it has taken 20 years for you to earn this money, that doesn't mean that you spread it over the next 10 years. The maximum time period should not exceed 3 years. Because that is when you are able to moderate the risk of catching a market high, and you are able to ride through a full market cycle as well, or a good reasonable part of the market cycle. The amount of money which you have to invest in equity and spread over a period of time as you stagger your investment into equity, there is a simpler way in which you can automate this whole process. That is called systematic transfer plan. Assuming that you want to invest in a fund, in an equity fund, and you want to spread this money to be invested over the next 18 months or maybe 24 months, next 2 years, and that too every month or every week. And if you are going to do this, and for this you want to put your 10 lakh rupees into one fund, you make that investment in a short-term debt fund or a debt fund or a liquid fund, and give a standing instruction that 1/24 of the value should be invested in the equity fund every month on a specific date. If you do this, your money will move methodically into an equity fund. With a single transaction, you will be able to execute, and the idle money, the money which will be lying there, which is not invested in equity, will also keep earning optimally. Arbitrage fund is also an option, and it is a tax efficient option, but don't bother much about it. If you invest in a debt fund and this money is definitely going to be moved into an equity fund, or if you invest in an arbitrage fund and that money will also move into an equity fund over a defined time period, whether it is 12 months, 18 months, 24 months, and the money which is not invested will keep earning. The primary objective of investing in a vehicle, in an arbitrage fund or a liquid fund or a debt fund, is that you are reducing the possibility of catching a market high. Let me give you an example, the devastation of catching a market high and how it has an impact on your investment behavior. Assuming somebody had this 10 lakh rupees in January 2008, and on 17th of January, the market went down by something like 10-15%. And over the next 6 months, it went down by about 50%. Market came down by 50%. So if you would have invested 10 lakh rupee, in the next 6-7 months, it would have been reduced to something like 5 lakh rupees, or maybe even less, if it was invested in a mid-cap fund or a small-cap fund. This is why you need to eliminate this possibility. If you would not have invested at one go, if you would have spread that investment over the next 6 months, only 1/6 of your money would have caught the high. The next 1/6 would have caught a lower price, then a lower price, then a lower price. So you are averaging downwards. And the primary objective of spreading this money is to reduce the risk of investing at the peak. And whether you do it in an arbitrage fund or you do it with a liquid fund, it is not going to make a huge difference.
That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.